It's Wednesday, 5th of August, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day. So today, you are looking at a market that is fundamentally breaking its own rules. It is caught in this fascinating tug of war between systemic chaos and, well, calculated precision.
Yeah, the divergence we saw yesterday is a perfect example of that chaos.
Exactly. I mean, the Sensex closed down 0.27% and the Nifty 50 closed down 0.64%. But the real story is not the dip itself, right? It is the sheer confusion surrounding the rollout of the new closing auction system, or CAS.
Right, the new CAS rollout. It caused some incredibly wild derivative price movements.
It really did. Implementing this new system right at the end of the trading day is, it's like changing the rules of musical chairs right as the music stops. It threw participants completely off balance. It even caused arbitrage fund net asset values to temporarily surge by nearly 0.5% in a single day.
Which is huge for an arbitrage fund.
Right. I mean, I understand the theoretical desire for a cleaner closing price. But if an administrative update causes arbitrage funds to jump 0.5% in a few hours, the plumbing is clearly leaking. Is this just a temporary glitch, or is this the new normal?
Well, the plumbing is not just leaking. I mean, the water pressure has completely changed. To understand the chaos you're seeing, you have to look at the underlying mechanics. Arbitrage funds thrive on absolute predictability, right?
Yeah, they lock in the price differential between the cash and futures markets.
Exactly. So when the new CAS alters how that final price is discovered by matching bulk buy and sell orders in a hidden window, it temporarily obscures the data. The trading algorithms just cannot calculate the final spread.
Oh, wow. So the algorithms essentially panicked because they were blindfolded for the last few minutes of the game.
Precisely. When they lose that line of sight on the closing price, their risk models break down. That causes them to misprice their own net asset values, which, explains that massive surge. The market will eventually adjust, but right now, investors might want to extend their holding periods rather than engage in short-term trading.
Because algorithmic and manual traders are still rewriting their risk models, right?
Yeah, exactly. Until that recalibration is complete, you will see unexpected volatility spikes.
Which brings me to the individual top movers, because they are showing extreme divergence. I mean, Best AgriLife, Restaurant Brands Asia, and Morpin Laboratories all shot up nearly 20%.
That is a massive single-day move.
It is. And on the flip side, you have Greaves Cotton tanking over 14% and Butterfly Ganamati Appliances dropping over 9%. If you track that momentum from the stock market tickers directly into the corporate boardrooms, you see how companies are navigating this environment.
Right, we're moving from market chaos into a period of surgical precision in corporate strategy. You can see it clearly in the corporate earnings showcase.
The numbers definitely back that up. NICA, or FSN e-commerce, saw their net profits surge over 300%. Pidilite net profit grew over 30% on double-digit volume growth. And Party Airtel's consolidated net profit jumped over 35%.
And that Airtel growth was driven entirely by a massive surge in postpaid and data users, excluding exceptional items.
Exactly. But I want to pause on the fast-moving consumer goods sector. This is where the strategy shift is just glaring. Morco saw profits rise 25% alongside a 15% revenue bump. But then Imami saw a 16% profit decline despite matching that exact same 15% revenue increase.
That divergence is really the defining story of this earnings season.
I mean, how does that even happen? Two companies in the same sector increase revenues by 15%, but their bottom lines move in violently opposite directions.
It comes down to input cost management and product mix. Marico is publicly prioritizing margins over volumes in commoditized sectors. They are selectively sacrificing market share to protect the bottom line. Imami, meanwhile, is absorbing the brunt of input cost pressures.
But wait, I have to challenge that approach from Marico.
Yeah.
Sacrificing volume in a consumer market of 1.4 billion people sounds incredibly dangerous, doesn't it? Aren't they just leaving the door open for regional competitors to steal their customers?
It is a calculated risk, definitely. But in a high inflation environment, defending volume at the expense of margin destroys shareholder value much faster. Marico is betting that their premium consumers are stickier. Now, contrast that with Muthoot Finance, whose shares dropped roughly 8%.
Right, because they are in the financial sector lending against gold. They do not have the luxury of premiumization.
Exactly. Their funding costs have increased, which means their net interest margin is getting squeezed.
Why can't they just pass that higher borrowing cost onto the consumer, though? just raise the interest rates on the gold loans.
Because gold loans are highly commoditized. If Muthoot raises rates too aggressively, the consumer just walks to a traditional bank with a slightly lower rate. This is why you are seeing Indian boardrooms shift from growth at all costs to strict margin protection.
So they're building toll booths on roads they already know are packed rather than paving new highways.
That is a great way to put it. Major capital expenditure is still happening, but it is highly calculated. Look at the JSW Group forming a standalone joint venture for its Volkswagen Alliance to target mass-market vehicles.
Right, ring-fencing the risk. And L&T just bagged a massive multi-billion-dollar equivalent offshore order from ADNOC in West Asia. It proves targeted industrial expansion is still thriving. But that brings us to the domestic macro environment, which dictates borrowing costs for all these companies.
And the data there is presenting a pretty massive paradox right now.
It really is. GST collections rose over 15% in July, which points to robust consumption. But simultaneously, manufacturing growth has slipped to a near 5-year low. You have booming tax receipts right next to sluggish factory output.
It is a mixed bag, absolutely.
So with all eyes on the imminent Reserve Bank of India monetary policy meeting, how does the RBI handle those conflicting data points?
Well, economists widely predict the RBI will pause rates, and the justification lies in the foreign exchange dynamics. Massive FX inflows are currently supporting broader economic growth, and that is offsetting the dip in manufacturing.
But wait, if manufacturing is scraping a 5-year low, the textbook response would be to cut rates to stimulate borrowing, right? Why ignore the manufacturing slump?
Because cutting rates right now risks triggering a much larger systemic problem. The Indian rupee has remained remarkably steady and virtually unchanged in percentage terms. That stability is actively supported by importer hedging and foreign portfolio investment inflows.
Oh, I see. If they cut rates, they narrow the interest rate differential between India and the developed world.
Exactly. That makes Indian assets less attractive. If foreign capital flees, the FX inflows dry up, the rupee depreciates, and imported inflation spikes. The RBI is prioritizing currency stability over a short-term manufacturing stimulus.
So currency markets are just holding their breath for the official signal. That stability feels even more crucial when you expand the lens to global shifts, because international markets are drowning in unpredictability.
They really are. Just look at the Japanese yen hitting a 3-month high due to confirmed joint U.S.-Japan intervention.
Right. And gold and silver are up slightly, less than 1%, and just over 1%, respectively. But the real shock is crude oil. Crude plummeted over 5%. I mean, oil prices dropping over 5% during a major Middle Eastern conflict is, well, it is like umbrellas going on a massive discount sale during a monsoon. What is driving this counterintuitive plunge?
It comes down to mediators in Qatar reporting progress in the U.S.-Iran conflict. Hopes for a diplomatic resolution and the potential reopening of the Strait of Hormuz are actively easing supply fears.
But I struggle to see how traders can justify that when the tactical reality on the water remains so dangerous. A diplomatic framework does not instantly remove physical threats.
The physical risks are still very severe. An Indian-flagged vessel recently sank in the Red Sea after a projectile strike from an explosive-laden boat.
Right, though thankfully all 14 crew members were safely rescued.
Yes, they were. But the market is looking beyond individual strikes. Reports indicate the U.S. has exhausted virtually all of its long-range precision missiles over the last 5 months of conflict.
Wow. That completely alters the leverage at the negotiating table. If you are out of precision munitions, you can no longer conduct surgical military operations. You are forced into forced diplomacy.
Exactly. The oil market is betting that this structural military exhaustion prevents a long-term blockade of energy supplies. It makes a diplomatic off-ramp a logistical necessity.
It is a fascinating application of game theory. Now let's take that concept of precision and apply it to our final segment, stepping away from geopolitics for a groundbreaking development in biotechnology.
This one is genuinely fascinating.
It is. Researchers have successfully developed a bioengineered chewing gum that targets microbes linked to head and neck cancer. I mean, fighting cancer with chewing gum sounds like science fiction.
It does, but the mechanism is incredibly elegant.
Usually treatments like antibiotics or chemotherapy act like a biological wrecking ball. They wipe out all the good bacteria along with the bad. How does this gum work without doing that?
It is all about biological precision. The gum is designed to specifically target and reduce human papillomavirus, or HPV, levels and harmful bacterial species to near zero levels. It uses specialized plant-based proteins embedded directly into the gum.
So as you chew, these proteins are released. But how do they differentiate between a beneficial microbe and the HPV virus?
The proteins act like microscopic magnets. They exclusively bind to the HPV virus and the specific pathogenic bacteria linked to cancer. They trap the dangerous microbes within the gum, leaving the beneficial oral microbiome completely unharmed.
That is incredible. It leaves you pondering just how far we can push this technology into our daily routines. Imagine a future where your daily toothpaste could actively rewrite the genetic markers for decay while you brush. We are watching the line between everyday consumer habits and advanced preventative medicine blur in real time.
And just before you go, a quick note, this deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only